Ladies and gentlemen, federal employees, what happens if you are, let's say, getting close to retirement, you're getting nervous because the market is being volatile and you move to the G fund? Or just in general, maybe you're not close to retirement and the market starts to be a little crazy and you move to the G fund. What is the impact to your retirement if that sort of thing happens? That's what we're going to talk about today. And the short answer is it can be catastrophic if you don't stick to your plan. You got to have a plan and stick to it. Let's talk about it. Now, I'm sharing my screen, as you can see here on the YouTube channel. If you're on the podcast, go check out the video so you can see the details. But long story short, I'm going to use a tool by Vanguard. Vanguard does a great job at offering some tools to show you what if you did certain actions, what would be the result, okay? So for example, this thing that I'm about to show you assumes you got about $1 million at retirement and that you're invested about 60% in stocks like the C fund, S fund, I fund, and about 40% in things like the G fund and F fund, okay? Now, what we're going to look at, and you can, if you go, you can Google this tool. It's super easy to find. Just Vanguard Market Hindsight, and you can find it. But basically what it shows us is if you, let's say when the market went down back in, let's say 2020 with COVID, right? Or beginning of 2025 when the tariff things really shook the market up. If you said, look, I want to get out. When the market's down, I want to get out. This chart shows us if you get out when the market is down, for example, here, if you got out at the bottom of 2020, right? You said, hey, I am out. I want out. Your money would have gone down to, from $1 million down to about 800,000 or so. And if you would have stayed in cash, the odds of you knowing exactly when to get out and get back in, because you would have had to get back in very quickly because the market recovered very quickly after COVID, very quickly. And so the odds of you picking exactly the right time to move out of, let's say, the C, S, and I fund and into the G fund, and exactly the right time to get back in is basically impossible. I see people all the time getting nervous. The market goes down a little bit and they sell to the G fund, right? They lock their money in at a low amount and then they come back in later when the market's a lot higher and they lost a bunch of growth in the meantime. Right? And if you keep doing this consistently, when the market goes down a little bit, you get nervous and you sell, and then you wait, and then you buy back later, you're losing a bunch of growth over time. And I get, especially as you approach retirement, it's scary when the market goes down. It's nerve-wracking. I get it. It's normal. It's human, right? I'm not saying you have to be a robot about this. I'm saying you've got to have a plan. If you have all your money in things that are fluctuating like this, yeah, that's a problem, right? Especially if you're retiring soon. Most Feds are going to want a mixture, some money in like the G fund, the F fund, some safety, as well as things that are going to grow over time. If you don't take any risk, if you don't have nothing in the CS and I fund, retirement becomes a long retirement and your money just probably won't keep up with inflation over time. And so again, you can use this tool to kind of show, hey, if I try to time the market, is that really going to work out for me? Because if you would have tried to time the market, let's say back in 2020, you said, look, I'm done. I'm done with this craziness. I'm going to just sell right here, right? If you would have sold, your money would still be worth about 800 some thousand. And if you would have just kept strong, it now would be worth something like 1.1 million or so. Okay. Or actually I back up. It would be 1.1 million just by the end of 2020, right? The end of 2020, just within probably 6 months or so, it was worth significantly more. But you have to be willing to ride out the waves. If you're not willing to ride out the waves, your results of retirement are going to be much less. Being financially prepared is a mixture of being financially diligent and disciplined. Knowing, hey, the market's down, but I'm not going to react. I've got a plan. I'm going to stick to it. And if you want to know more about how you should probably be investing in retirement, we've got whole videos on that, or you can reach out to our team, see if it makes sense to work together. You can check out our website at hawsfederaladvisors.com. And I hope that's helpful. And I'll see you guys in the next video.